Well, good morning, everyone, and thank you for joining our signature education series today on tax strategies and real estate. We are very excited to have Larry Wurzel with us today with Advantage Tax and Business Services. And so I'm going to go ahead and give Larry an introduction, and then I will hand it over to him. During the presentation, I will be monitoring the chat, so please feel free to enter any questions that you may have into that chat, and then I can go ahead and ask Larry those questions when we get to that point in the presentation. And we are recording today's event as well, so if you would like a copy of the recording, I will have that available later on following the event. Okay, Larry, we're going to get started.
Okay.
So Larry is a UCLA, excuse me, a UCLA graduate, owner and operator of manufacturing and business services. He's been a Reno resident since March 2017. He is an enrolled agent, bookkeeper, QuickBooks Online Advanced Certified Pro Advisor, QuickBooks Desktop Certified Pro Advisor, a member of the American Institute of Professional Bookkeepers, a member of the National Association of Enrolled Agents. And Larry, we are so excited to have your expertise with us today. We get so many questions regarding taxes and what real estate agents can do as part of their planning process. And so just a few of the topics I know you're going to be hitting on today in how to minimize your taxes and reduce your record keeping burden, the pitfalls of not filing or paying your taxes, business structures, common realtor deductions, common tax issues for realtors, and estimated tax payments. So I'm going to go ahead and stop the sharing of my screen.
Okay.
Which will now give you the controllers to be able to share your screen. And Larry, I'm going to hand it off to you. And thank you again for joining us.
Okay, thank you. Hi, everybody. Good morning. Just give me a minute here. Can you see, which screen are you seeing?
Right now, I see you still.
You see me still.
And your beautiful background.
Share screen 2. Okay, share. And now play show. Hang on one second.
Okay.
I'm waiting.
And you just select the screen that you want to share.
Okay, yes. So you should be basically seeing my business card there. Is that correct?
No, I still see you. I still see you.
You still see me. Well, that's not working. Okay. It says it is sharing. Well, let's see if I share. How about if I stop the video? I don't know if that's going to make any difference. Stop the video.
It's changing.
Okay, and now
we still see a black screen though.
Okay, well, let's just see if I can get it to no, hold on, it's not responding. Uh-oh. Seems to be hung up for a minute. All right. I'm going to have to kill this.
Larry, I have the presentation you sent me as well, if you want me to go ahead and share that for you.
Okay. Raquel.
Yes.
You may have to add me back.
Okay.
As a
there you go.
All right. I'm going to share screen.
Okay.
share. Okay, and now
There we go.
play this.
I see your Zoom screen now.
Okay, good. Well, that's a start.
There we go.
Okay, sorry, everybody. All right, well, good morning. And as Raquel said, my name is Lawrence Wurzel, and this presentation is about you and me and our Uncle Sam. And we're going to try and take some of the mystification and resolve some burning questions I know you all have. Raquel went over my bio, so I just want to spend a second on the enrolled agent credential. I'm sure everybody is familiar with the CPA designation. The difference between CPAs and enrolled agents is that one, CPAs are licensed by the states, and EAs are licensed by the IRS. So an EA can practice nationwide, where technically CPAs can only practice on file returns in the state returns anyway, in the states that they're licensed. The EA designation has been around since the Civil War. If you haven't heard about it, it's because CPAs have done such an effective job of marketing that everybody thinks that if you need your taxes done, you have to go see a CPA. That's not the case, and I would encourage you to seek out a reliable enrolled agent, because you will typically find that you will save hundreds of dollars in your tax preparation fees. EAs can represent taxpayers before the IRS, the same as CPAs. The big difference is that CPAs are trained in some disciplines that really don't apply necessarily to tax, like regulation and auditing and things like that. So enough said about that. If you don't know, I will tell you that if you don't file and pay your taxes, bad things are going to happen. And I would encourage everybody to try and stay current with their filings. It's even if you don't have the cash to pay, it's better to file than not to file. We can talk about all that, because eventually it can lead to seizure of property and or levies on your bank account. So you really can't mess around with the IRS. We talked about EAs versus CPAs. Okay, so there are 5 different ways you can conduct business. You can conduct business as a sole proprietor, which basically takes almost no action. All you would really need in your cases would be a real estate license, or whatever license your particular business might require. There's partnerships, which is 2 or more unrelated people joining together. There's corporations. When I say corporations, I'm referring to C corporations. There's S corporations. And then there's this hybrid called limited liability companies. So we're going to talk about how each one of these structures files their taxes and how that can impact how much you pay, because there are some differences. Okay, so the sole proprietorship, we'll start there. This is the easiest one to set up. Like I said, all you need is a business license. If you don't want to do business under your name, you could get a fictitious name and operate under that name. The disadvantages of the sole proprietorship is that 100% of your net earnings, so net earnings, I mean after expenses, 100% of net earnings are subject to both income taxes and self-employment taxes. And I want to just self-employment taxes. Self-employment taxes are different than income taxes in that self-employment taxes, which are comprised of Social Security and Medicare, actually buy you a benefit. That is to say, if you were to pay the maximum in Social Security Social Security taxes over your working career, you would then be entitled to the maximum benefit, whatever that was at that time. And it follows that if you pay less than the maximum, you may get less than the maximum Social Security benefit when you retire. So the strategies that we're about to discuss involve mitigating self-employment taxes. So what I'm saying is if you're gonna mitigate your self-employment taxes, you have to be aware of the potential effect on your Social Security benefit at retirement. But as long as you're aware of it, there are many valid reasons for doing what we're going to talk about, and we'll discuss those in a minute. And the other disadvantage of the sole proprietorship is no liability protection and high audit rates. One more thing about the income tax and self-employment taxes. Self-employment taxes are roughly 15% of your income, okay, up to the maximum of about $147,000. And that does not include income taxes. So you can see that if your income tax rate is 20%, and that's not a number that's hard to get to, and you add on top of that 15% self-employment taxes, you're now 35% right off the bat. Okay, so let's go on and we'll show you how all this flows. Again, the sole proprietorship, no liability protection, and high audit rates. And I can't tell you why the audit rates are higher. I would suspect it's because a lot of people file their own Schedule Cs and make mistakes. And also the IRS perceives these returns as low-hanging fruit. Okay, so the next business structure is a partnership. A partnership, you have two or more people that can collaborate. The partners share the responsibility of managing the company. In some cases, partners are not required to file income taxes as a separate entity. That's a rare case. We're not really going to talk about that at the moment. Most partnerships file a separate return for their business entity. So that's one drawback right there. You have an extra tax return that you don't have as a sole proprietorship. The disadvantages is the partnership, again, offers no personal asset or liability protection. You could also maybe even be liable for the acts of your partner. And again, 100% of ordinary income is subject to income and self-employment taxes. So if I were to draw up a scenario and compare the tax liability of a partnership to a sole proprietor and use the exact same numbers, the tax liability really would come out virtually the same. Corporations. So now we're talking about C corporations. Corporations provide the directors and officers liability protection. A C corporation is also a great structure if you plan on, if you want to raise money from a lot of different people. You can also issue bonds. The downside to the C corporation is that the C corporation pays currently under the tax law, 21% flat tax on all its profits. So the question is, why is it double taxation? Well, if the corporation has to pay 21% on its profits, and then it distributes them to the stockholders, that's a dividend. And dividends are again taxable. Okay, so there's no real tax savings for most of you with a C corporation. The next entity type is the S corporation. So an S corporation is a pass-through. A pass-through means that the entity pays no tax. Whatever gain or loss is on the entity tax return passes through to the shareholder or the partner. So for that reason, they're called pass-throughs. The S corporation gives you the ability to mitigate SE tax, self-employment taxes. We'll go into that in a second. Their S corporations have lower audit rates. Now, this is looking back. It's not looking forward. So there's no guarantee that tomorrow the IRS won't decide to go after a whole bunch of S corporations, but it hasn't been the case. And they're so, I'm sorry, and they're so overwhelmed and understaffed that it's hard to imagine they're going to be able to do a very thorough job. There's fewer administration requirements than C Corps. The disadvantage is that it's more costly to operate than a sole proprietorship or a single member LLC, which we'll talk about. 100 shareholders maximum. Officers have to take a reasonable salary. And you have to keep in mind what I said before, that paying lower self-employment taxes may affect your Social Security benefit at retirement. Okay, so the limited liability company, or LLC, is a hybrid. And as such, it can file taxes several different ways. So a single member LLC is a disregarded entity for tax purposes, which means you file as a sole proprietor. So think back to an earlier slide where we said that the sole proprietor pays income and self-employment taxes on 100% of net earnings. So if you form a single member LLC, you're right back where you started from. There's no real tax advantage. The only advantage would be some outside liability protection. If you have more than one member and you form a limited liability company, the IRS by default makes it a partnership. Okay, now, either one of those limited liability situations, the single member liability or the multi-member, once they form the LLC, can then make an election with the IRS to file as an S corporation. There is no direct path to an S corporation. You can either form a corporation and then elect S corporation status, or you can form an LLC and elect S corporation status. Just keep in mind that if you're going through this, it is a two-step process. Okay. We talked about self-employment taxes. I apologize, the chart's 1 year out of date. The 2021 self-employment maximum is 142,800 instead of 137,700. So FICA and Medicare 6.2 plus 1.45 is 7.65%, and that is levied on both the employee and the employer, okay, up to that maximum 142K. Beyond 142K, you still pay Medicare of 1.45%, and there is no cap on that. And then, well, there's some Medicare premiums here, but these Medicare premiums are based on income, so you really have to refer to current tables for these. So here's a comparison between, let's call them a realtor, and one in column 2, you have the sole proprietor or the single member LLC. Remember, I said that they end up being the same. And in the third column, you have the S corp numbers. So in both cases, we have $150,000 in revenue. We have $50,000 in ordinary expenses, whatever they are, dues and subscriptions, continuing education, automobile expense, software, etc. And that leaves the sole proprietor with $100,000 profit. Okay, we're going to stay on this column for a minute, and then we'll jump back to the other one. There currently is a 20% deduction for qualified business income. that would reduce your net to $80,000. It says net pass-through, but in this column, it's just the net on your income tax return. There are no wages paid to you from a sole proprietor or a single member LLC. The owner is not an employee. You do get a deduction for some of the employer's share of payroll taxes that you have to pay, because remember, as a sole proprietor and a single member LLC, not only do you have to pay payroll taxes on the employee's share, but you also have to pay the employer's share, but you do get a deduction for that. Okay, so that leaves adjusted gross income here of $72,935. So let's just go back here to the S Corp. The S Corp paid, the S Corp paid you, you're an S Corp, you're the only member. It paid you $50,000 in wages because you were able to determine that that's a reasonable salary for somebody working your amount of hours in your industry, and percent and the effort that you're putting into it. So $50,000. So that's also a deduction from the 150. Additional expenses of the S Corp, about $2,300. We'll talk about that in a minute. The company also has to pay payroll taxes on your $50,000 in salary. So that's an additional expense. So the net profit of the S Corp now is $43,000. It also gets a 20% deduction. It passes through to the owner $35,000 in income. In addition, the owner got a W-2 from his company for $50,000. So the adjusted gross income of the S Corp is $85,000, of the S Corp owner is $85,000, whereas the adjusted gross income of the sole proprietor single member LLC is $73,000. In a simple case, you have a standard deduction. Some people itemize, so the standard deduction is a little higher than this now. And of course, if you're over 65 and or blind, it's a little bit higher than that. You subtract the standard deduction from your adjusted gross and you arrive at taxable income of $48,006 and $61,000. At the time these charts were prepared, the marginal tax rate, that is the rate that's paid on the last dollar of income, was 12% versus 22%. So the tax for the sole proprietor is $5,500. That's the income tax. The S Corp, it's $11,000. Okay, but here's where the savings is. The self-employment tax on this sole proprietor is $14,000. There is no equivalent tax on the owner of the S Corp. The owner did pay an additional $3,800 in payroll taxes on his wages. So when you add up the income tax and the payroll tax, in my example, the S Corp saves over $5,000. So that's a big savings if your gross is $150,000. Now, not everybody is going to experience the same savings. Some may save more, some may save less. Really, how much you save depends on how much you're able to exclude from payroll taxes. You're going to pay the same amount in income tax. You're just going to pay less in self-employment taxes. And remember, the self-employment tax buys you that benefit we talked about. And here are some, these are 2021 tax rates. So you can see they top out at 37%. And remember, tax rates are marginal. So you've often heard somebody say, I don't want to make any more money. It's going to bump me into a higher bracket. Okay. You're never going to take home less by making more as far as your income tax rates go, because it's only the last dollar. So in this case, if you made $40,526, which is $1 more than the 12% bracket tops out at, you would only pay 22% on that $1 of income. Okay, all the rest between these are taxed at this, and everything under this is taxed at this rate. Okay, so that's an important concept to make sure you understand about marginal rates versus your total tax rate, which would be your total tax over your total income. Okay, so the first thing you want to do is try and decide which entity type is right for you. Consult with somebody. Look at what your projections are in terms of income. Typically the S corporation strategy only works if your net is about $50,000. So if your net is much less than that, you're probably not going to save any money in taxes as an S corporation. But as it goes up, you probably will. Okay. Obtain a business license. Open a separate checking account. If there are people out there who are real estate brokers, they're really an agent, to open a separate business account and just use that, pay your business expenses, deposit your business income, because at the end of the year, it makes record keeping a whole lot easier. And then the last thing is you really have to begin tracking your income and expenses in some manners, okay? You have to keep records, because poor records will lead to an inaccurate tax return, and that could trigger an audit. And remember, in an audit, typically they don't audit 1 year, they audit multiple years. And you're gonna be looking for records that are, 4 years old or more, perhaps. And in order to produce those records and prove your deductions, you need to be organized. Okay. And in terms of keeping documents, I keep documents 10 years. Easy number for me to remember. There is a statute of limitations, but the IRS can, if they allege fraud, there is no statute. So beware. Okay, so record keeping methods, bookkeeping methods. Some of you use a shoebox with envelopes in it labeled meals, gas, whatever. That's one way. A spreadsheet is quick and easy to set up as well. The problem with both of those first two methods is that they're time consuming and they don't necessarily produce accurate results. The QuickBooks Online, as well as other online accounting programs, are relatively inexpensive, and they link with your bank and credit cards, and in a lot of cases they can help people get organized. The downfall, they're subscription based, which means it's monthly fee, and it requires some knowledge of bookkeeping. There's also desktop programs like QuickBooks, no subscription, but again, you need some knowledge of bookkeeping, and with a desktop program, only you can access the information. You can send the file to your accountant, but unlike QuickBooks Online, you can't really both have access to it at the same time. And then there's professional service. So the advantage to professional services is that it takes your attention away from the record keeping and lets you focus on your business, which is really where you're going to make your money. You're not going to make any money doing your own bookkeeping. Other advantages: you'll receive periodic financials. You'll have confidence your books are correct, and you'll have a professional who you can ask questions to when issues come up. Okay. So deductible expenses. Any expense is deductible if it's usual and necessary. Okay, so there are some expenses that for one business would not be deductible, and for another business they might be. All right, so anything that's reasonable. Clothing, however, business attire is not deductible unless it can't be worn outside of work. So an example of that would be a uniform at Burger King, let's say. Okay, but a suit for a meeting doesn't qualify unless maybe it has a patch on it that says, that has your company name on it. Okay. Spend a minute here on employee or independent contractor classifications. If you have people working for you, you as the employer have to decide whether they should be classified as an employee or an independent contractor. An independent contractor is less expensive to hire than an employee because there are no taxes. However, there are downsides with classifying people independent contractors, and the classification parameters are issued both by the states and by the IRS. Okay, so here's it. The general rule is an individual is an independent contractor if you, the person for whom the services are performed, have the right to control or direct only the result of the work and not the means, methods of accomplishing the results. Now, that's a very generic statement, and many states, especially California, have tightened up these rules such that it is difficult now to qualify as an independent contractor. So, like I said, the independent contractor is less expensive, but if you hire an independent contractor, there's no workers' comp coverage because they're an employee, and there's a large potential liability if incorrectly categorized. So how these things typically go is you hire an independent contractor, you classify them as such. The relationship turns sour, you fire them, they file an unemployment claim, they send it to you, you say, oh no, they were an independent contractor, and that goes back to Dieter. Dieter then sends it to the employee says, oh no, I was an employee, I wasn't an independent contractor. And now Dieter has to get involved and do an employment audit. Okay, and that can be very painful. It can go back several years and can result in large penalties. The workers' comp issue is the same thing. That independent contractor could get hurt on the job, be denied coverage, but then sue because he says he was incorrectly classified and he should have been covered. So it can be quite a mess. So be very careful with respect to how you classify people who are working for you. Also, if you do hire an independent contractor, you should be getting a W-9 when you first do business with them. The W-9 is just an information form that gives you the name, address, and tax ID number of this contractor and how they file their taxes. So at year end, you know whether you have to issue them a 1099, because 1099s have to be issued to any person or company that doesn't file like a corporation that you pay over $600 or more for services or rent. Okay, so that's another obligation of the when you have independent contractors working for you. Okay, so entertainment is no longer deductible for federal purposes. Business meals, they're 100% this year actually at full service restaurants. They've been 50% in the past. They will go back to 50%, I think, next year or the year after. However, for a business meal to be deductible, you have to keep a receipt with the date, the client name, and the purpose of the meeting. Okay, if you present your Visa bill to an IRS auditor with all your meals on it and not all the restaurants on it and nothing else, those deductions would be denied. Okay, car expenses. So if you use your car a lot, and most realtors do, then you have significant expense in maintaining the car and paying for operating expenses. If you want to deduct the business use of your car, again, the IRS requires that you keep records. And besides the records of the expenses for the car, you have to keep a mileage log that has information like date, beginning mileage, ending mileage, purpose of trip. And there are some apps you can get to help you with this. But in an audit where you have deducted automobile expenses, the IRS will invariably ask for this log. So qualified business use of the car includes driving to business meetings away from your usual workplace, meeting clients or customers, getting from your home to a temporary workplace, getting from your regular workplace to a second workplace. Okay. Now, if you use your car only for your job or business, you can deduct all the miles driven. Okay. There's a per mile rate, or you can take actual expenses, whichever benefits you more. But if you use the car for personal use, then you can't deduct 100%. And basically, the way the car deduction works is you would add up all the costs for operating your car for the year. So let's say the lease payment or the interest on the loan, gas, insurance, registration, repairs, car washes, everything. You'd add them all up, and then you would multiply times the ratio of your business use over your total use. So if you drove 10,000 miles during the year total, 5,000 were for business, you would be able to deduct 50% of your actual expenses. You can also choose to take the per mile rate, which for 2021 is 56 cents. It actually went down a couple of cents. But regardless of which way you choose to calculate your deduction, the log is critical if you get audited. Business gifts. I know a lot of realtors give gifts to clients who they're successful in a deal with. For tax purposes, they're only deductible for $25 per person per year. That number hasn't been adjusted in, I think, 200 years. Okay, so you also potentially have a deduction for home office. And to qualify to claim expenses for the business use of home, you have to meet both of the following tests. The business part of your home must be used exclusively and regularly for your trade or business. So you can't really say, I do all my work on my kitchen table, therefore I'm going to deduct my kitchen or the area where my kitchen table is. That doesn't work because you can, you eat at your kitchen table. So it doesn't have to be a whole room, but the use has to be exclusive. Okay, the second test is the business part of your home must be your principal place of your business or a place where you meet or deal with patients, clients, or customers in the normal course of business, trade or business, or C, a separate structure used in connection with your trade or business. Now, there's a couple of exceptions to the exclusive use here that have to do with daycare or storage. We skip those for now. Your home office qualifies as your principal place of business if you use the office exclusively and regularly for administrative or management activities of your trade or business. So it is totally possible that a realtor could claim their home office as their principal place of business. Yes, they may go in occasionally to meet clients somewhere else, but if they use their home for the management and administration of their activities, then it would qualify. And the reason establishing your home as your principal place of business is important is because besides being able to take the deduction for the space, you are then also able to deduct all your mileage from your home to everywhere else because it's your principal place of business. All right, a little more about.
Larry, there is one question about if there are any systems that you can suggest for logging the automobile expenses.
Yeah, there's one called Mile IQ. And I'm sure if you go into go to the App Store and just search for mild IQ or mileage tracking, you're going to get.
That's the one I use, as a matter of fact.
There you
So
go.
yes,
There
yes.
you go. Okay. I mean, they're not. You still have to, at the end of the day, categorize things and enter notes, but at least it gives you some structure to do it.
Definitely.
Right. Okay.
Thank you.
You're welcome. All right. So there's a couple of other minor issues with business use. If you have more than one place of business, and there's a couple of different ways to figure the expense. Like the automobile expense, the way it's calculated is you add up the total cost for maintaining your home during the year. So mortgage interest, rent, repairs, insurance, utilities. You add all that up and you multiply times, again, a ratio of the square footage of your office over the square footage of your home. So if you live in a 3,000 square foot home and you occupy a 150 square feet of office, right? You get to deduct, what is that, 5%? I believe so. Right, you would get to deduct 5% of the total cost of maintaining your home. Okay, that was the business use. Now there's an optional safe harbor method, but it's only good for 300 square feet at I think $5 a foot. So I think it's either a $1,500 or a $500 deduction. It's small. Okay, common tax issues for realtors and their clients. Okay, calculating the gain on the sale. All right, the cost of a home plus capital improvements equals what's called the basis. Improvements are not paint. They are, capital improvements, more square feet, a redo of a room, a swimming pool, a fence, okay, all these things. I will interject at this moment that when we talked about how long you keep records, and I said I keep them for 10 years. That's some records. Records that pertain to a home that you own or any capital asset, you have to keep until 10 years after you sell that home. Just had a client who went through an audit on the sale of his home, and the auditor wanted all the receipts for his capital improvements. And you know what? It was 15 years ago. The pool guy was out of business. He didn't keep records, and he lost the deduction. Okay, so the basis is cost plus improvements, selling price less selling expenses less the basis equals the gain. Okay. Now, and then there's the Section 121, which allows single taxpayers to exclude the first $250,000 of gain, married $500,000, provided they've used that residence as their principal residence for at least 2 of the last 5 before the sale. Okay, so in a lot of cases, you know, this Section 121 gets most people out of paying any tax at all on the home, but you could have people coming from California where they've owned a home for a long time, and if in a couple, and the $500,000 may not be sufficient, and then they would have a long-term capital gain. Okay. Okay, long-term capital gain rates. So long-term capital gains are taxed differently than ordinary income. If you remember back to the original slide, and there will be a test at the end, the top rates were 37%. But you can see that in the capital gains, the top rate is 20%. And these rates are correct, although the numbers here are a little bit different. Okay, so capital gain rates are much lower. The top capital gain rate is much lower than the top ordinary income tax rate. Okay, and 1031 exchanges. All right. So first thing about 1031 exchanges is make sure you work with a professional 1031 service. Don't try and do it yourself. There are strict rules about the timing of identifying the exchange property, closing on the exchange property, and if you miss those, you're going to blow the whole concept, which is really to defer income taxes on the gain. Okay, that's what a 1031 exchange does. It doesn't eliminate the tax. It just defers it till you sell the new asset, or perhaps exchange it into another asset. Now, both the relinquished property and the replacement property have to meet several requirements. First of all, they have to be used in a trade or business. So you can't trade your personal residence for another personal residence and use a 1031 exchange. But there's also this concept of like kind. Like kind is pretty broad. I mean, the code says it's property of the same nature, character, or class, quality or grade does not matter. Most real estate will be like kind to other real estate. Okay, so for example, real property that is improved with a residential rental house is like kind to vacant land. So like I said, it's a broad definition, but we can say that you can't change a residential rental. You can't exchange a residential rental for a tractor, okay, for your farm. That would not be a like kind exchange. Sorry. Okay, so real property, personal property, most qualified as exchange properties, right? But you can never, real property can never be like kind to personal property. All right, remember, personal property can also be for business use, is how we're using it in that previous slide. Okay, 1031 time limits. Doesn't have to be simultaneous, but the first limit is you have 45 days from the date you sell the relinquished property to identify the potential replacement properties. Okay, and then the second limit is that the replacement property must be received and the exchange completed no later than 180 days after the sale of the exchange property or the due date, et cetera, et cetera. So, and then there are all these qualifications in between. So that's why we talk about using a service and not trying to accomplish this exchange yourself. All right, so once your tax return is filed, your tax preparer will send along with your tax return and any amount due for that year, any refund coming to you. They'll typically send along quarterly estimated payments, which need to be made during the year in order to keep your tax liability as low as possible, because the government does charge you fees and interest if your withholdings don't equal a certain percentage of your tax by year end. Okay, so let's sum up and then we can take some questions. You can reduce your taxes and liability by selecting an entity. In our case, we talked about the S corporation. Okay, good record keeping, timely record keeping will enable you to estimate and plan for your tax payments, which is really important. If you know you have if you've had a good year and you're going to have, you're going to owe taxes at year end, you want to be setting that money aside. But if you don't know what your income is, then you could be in for a rude surprise. And then we have retention of receipts and records will help substantiate your deductions in case of an audit, because remember, in front of the IRS, you're guilty until you prove yourself innocent. And that's all you never wanted to know about taxes. I'm sorry to, if I went too fast, I apologize. I'll certainly be available to take questions. In a lot of cases, the questions are best answered separately because all tax tends to be individual, and no one answer is going to fit for everybody.
And so, Larry,
yes.
you recommend if they do have questions to go ahead and email at larry@advantagetaxandbooks.com.
Yes, I am currently still taking new clients, and if there are attendees out there that need somebody, I recommend just send me an email and we'll get the conversation started.
Okay. Okay, if anyone does have any questions that you would like to add into the chat really quickly before we end our presentation today, please feel free to do so. And Larry, thank you so much. I know this is a topic that everybody dreads having to deal with, but having the information makes it be at least more pleasant to know what direction to be going in. So thank you for joining us.
You're welcome. It's a little daunting for everybody when they first get into business. And I was no different. It takes a few years when you've gone through a few cycles of business and tax returns, the whole thing. So you kind of get it under your belt and absorb it and get your arms around the whole process. But that's what professionals are for.
Right.
So,
that's right. That's why people need to use realtors as professionals when purchasing and selling their homes, and use you for their taxes.
Exactly. So I guess with that, I'll sign off. And I want to thank everybody, and good luck out there. Your taxes are due, your personal returns are due April 18th this year, which is a Monday. Corporate returns are due, S Corps partnerships due 3/15, C Corps again due 4/18. And that's about all I can memorize each tax year. I got to look everything else up. Okay.
Yes. And for all those in attendance, I will send out a link to today's event once the recording is done. And I will also be able to provide you with a copy of Larry's presentation, so you'll have that as a reference also. So Larry, thank you again for joining us. And thank you everyone for being on this today. Have a wonderful rest of your day.
Thanks, Raquel. Bye-bye.
Thank you.